There's a new narrative right now about the path of interest rates for this year. Apollo's chief economist, Torsten Slok, says there's a possibility that the Fed will not cut interest rates this year. Honestly, I made that point a few days ago. I don't think, in my opinion, I don't think that's the base case. However, if the economy proves really resilient and inflation still stubbornly high in that 2 to 3.5% range, then the Fed may not choose to cut interest rates. I still think that they will probably cut Q3, Q4, but Torsten Slok making this point, though that article really gained was a little bit viral, and yes, I think it's possible, but I don't think that'll necessarily stall the rally in the markets fueled by AI. Nvidia just topped $2 trillion. Based on Dell's really strong earnings report and Dell's demand for Nvidia's GPU AI chips. And I think, as I mentioned in previous videos, the tailwind of AI is stronger than the headwinds of CPI and even rates higher for longer. Obviously, we'll have to see. But yes, it's certainly a possibility that the Fed may not cut rates this year. Markets, I think, are due for a little bit of a... Obviously, the mid to long-term trajectory is higher for sure based on the tailwinds of tech and AI. And with the the cup and handle pattern of the NASDAQ just hitting its all-time high in 2021, I think is bullish. That doesn't mean that we can't have a 5 to 7% short-term pullback. I think that'll personally be short-lived and will be a buy the dip opportunity. But it's something that we should look out for soon. I think we'll be due for it at some point. We also have a lot of economic data and big political events this week. We have the jobs report. We have Jerome Powell testifying. We have a number of Fed governors speaking. We also have Super Tuesday, which is going to be interesting to see the ramifications of that, as well as the State of the Union this week. So there's a lot of things going on this week that may be a catalyst for the markets. And a lot of people were, well, not a lot of people, but some people aren't believing that this rally has legs. But historically, a strong January and February usually bodes pretty well for the market the rest of the year and 1 year out. And it seems right now we're no longer in the disbelief stages of an early bull run. The bull run that started in early 2023 is really gaining steam right now. And more people are believing it. More bears are turning bullish. This is a good sign, although something we have to watch a little bit. We don't want there to be too much euphoria too soon. But it's interesting to see that more people are believing in this market and in this market rally. The main reason I don't think this market rally isn't necessarily overextended is that this market rally is driven by fundamentals and underlying strength and demand in AI and tech spend. We're hearing companies spending more money on technology and AI in order to be competitive. And I think the earnings growth and margin expansion that we're starting to see is indicative that I think the market, even the AI and tech sectors, are fairly valued right now. And if anything, will grow more into their prices. So I think right now that we aren't overvalued, and I think, despite, as I said earlier, that there might be 5 to 7% short-term pullback at some point soon, it'll likely be short-lived and a good buy the dip opportunity.